Hello, everybody, and welcome to a I should turn down the special edition of Narrative Live on Substack. I'm delighted to have William K. Black here with me tonight to answer all sorts of questions related to the SNL crisis and corruption in our system. Hi, Bill. How are you doing? Welcome to the show.
Hello, great to be here.
I see a lot of people are piling in. This is an exclusive for our paid subscribers, so the numbers are smaller than we traditionally have on these shows. But the quality, I should say, of our paid subscribers is quite remarkable. Very smart, engaged viewers, and we'll be here to take all your comments. This is the nicest part about doing it at the smaller, more intimate crowd, is we'll be able to really take your questions. Please feel free to pop them into the chat. I'm watching this. A lot of people are saying they're very excited and looking forward to the show. Hey, Nick, nice to see you as well. So we'll be doing a lot of talk about SNL. We'll talk about Black Monday. We'll talk about the greatest heist. We'll also talk about the resolution trust companies and all sorts of things that William is very well aware of, obviously. So let me tell you about Bill Black. He's the federal regulator who helped prosecute over 1,000 banking executives during the savings and loans crisis. Now, that's the last time, I think, in American history that bankers actually went to prison for anything, really, but probably for financial fraud is the last time. Bill, is that right, Bill? Is that you were sort of the last
In
big?
any significant numbers,
Yeah,
yes.
unbelievable. You also wrote the
By
book.
the way, in the Enron era scandal,
Yeah,
the banks were heavily involved and they were almost entirely not prosecuted there either.
it's unbelievable how so many people have gotten away with so much theft over the years. You wrote the book, the best way to rob a bank is to own one, which sort of says it all. That most of these, criminals find their way into the banking system because it's easy. It seems to rob a bank if you own one.
It's not only easy, but it's easy to get away with it,
Mm.
which is the point. So the one great exception was the savings and loan and bank scandals of the 1980s and early 1990s.
Now, that didn't duplicate into the 2008 financial crisis. That seemed to be no one was really charged or convicted or indicted for anything there, except maybe one case, if I recall correctly. It is all tied in when you really look back at it, right? I mean, it's when you start looking at Black Monday all the way into the SNL crisis into 2008, they all seem to flow into each other.
Well, the great financial crisis is the third act of the
Mhm.
savings and loan debacle.
Right. Okay. Well, that's a good way to put it. What is the first act?
The first act was inflation,
Mhm.
stagflation, and the Arab exporting nation boycott. So you had huge cost rises, and the Fed didn't do much. The Treasury didn't do much. And finally, Volcker, Paul Volcker, chairman of the Fed in the United States, said enough is enough, and he raised interest rates to 18%.
Right. And that's
Savings and loans made fixed rate
mhm.
mortgages at like 7%. So the market value collapses if you aren't you aren't receiving a market rate of return. And so by mid 1981, on a market value basis, the entire industry was insolvent by $150 billion. And the insurance fund was $6 billion. You can see the problem.
Right. That is a huge difference there. Now, you were responsible for which agency? Tell us what agency that was.
Such a simple question.
Yeah, it's not that simple, I know, but there's a few of them
Okay,
as well.
so
So,
the first one was called the Federal Home Loan Bank Board,
mhm,
and it regulated savings and loans. It was a federal agency. And I was in Washington in a couple of different positions that we can go through if it's relevant. Then I was at the Federal Home Loan Bank of San Francisco, which the Brits would call a quango, a quasi non-governmental
okay,
organization, sort of mixed. And I was the general counsel of that. And then there was the Office of Thrift Supervision, a successor federal agency, and I was in it as well, where I frequently came up against that third act of the great financial crisis that becomes the great financial crisis, and against Milken's forces. You referred to Michael Milken.
Right. We are going to go into Michael Milken and Leon Black as well. But if you look at this whole thing, would you say this all started in the 70s? The SNL crisis, would that be its
Well,
origins?
the SNL crisis itself, those three acts,
Mm,
there was a test bed for that. And the test bed was almost exactly a decade earlier. And it's in the epicenter is in Texas. And that involves about 50 banks and savings and loans. And those folks come back and become the second act of
okay.
the savings and loan crisis.
So tell me more about the first act, just so I got an idea of what the difference is between the first act, for the 70s piece of it, the Texas piece of it, and then how it generates into what's the difference between that and the second act then?
Sure. Um, the first act is not fraudulent
Mm,
in the usual sense, although I'll get to some agency fraud
yeah.
of all of this in the cover up. If you own a fixed rate bond that has any length to it, and US mortgages are extraordinarily long compared to the rest of the world, 30 years, and they were fixed rate. So they're only paying whenever they were issued, say 6% rate of interest.
Right.
Now, the market rate of interest goes up to 18.5% because the Fed raises interest rates to try to deal with this persistent inflation that follows the Arab oil boycott in particular, and of course the Vietnam War.
Mm,
So now, if you're holding an asset that's only earning 1/3 of the market rate, it ain't worth
right.
$300,000, right? It's only worth 200,000. So if you took those market value losses collectively by 1981-ish and through 1983, the industry is insolvent by 150 billion.
No.
For scale, its supposed assets were 750 billion. So
Mm,
roughly it's insolvent by 20%.
wow.
Further for scale, we're also the insurance fund, the federal insurance fund. Everybody is probably familiar with the FDIC.
Yep.
This was the savings and loan version. And we only had $6 billion, and 6 billion is a lot smaller than 150 billion.
Right. A lot smaller. So you were facing insolvency from a very early stage of this crisis.
Immediate
Yeah.
and systemic, right?
Mm,
So the whole industry, every single savings and loan, 3,000 of them is insolvent, not to the same degree, but each one is insolvent. They're all doing essentially the same thing, except the fraudsters who are going to produce the second act.
So then we get into, I don't know if this is the second act, but you'll tell me in a second, into 1987, the Black Monday crash of 1987.
No, the second act begins around 1980.
Okay.
So it's much earlier.
Okay.
Uh,
So tell us what that is then, and then we'll get into Black Monday.
okay, so as I said, the test bed for the second act was this earlier scandal that was called the Texas Rent-A-Bank
Mm,
scandal. And that name is important and gives you one of the many ways you can run these frauds. Most of the frauds I'm going to be discussing are looting, right? The CEO is looting his institution.
mm,
And that has enormous value because he controls everything, but he also has seeming legitimacy. So you
right.
don't suspect the CEO. And most people think it's irrational. Why would the CEO, ruin the thrift or the bank when
He's
that
the
was
CEO.
going bad for him? But
Yeah.
it's actually a way to take an already insolvent savings and loan, back to my discussion of the
Mm.
first act, and make a ton of money out of it as a sure thing, not as a difficult risk proposition, but as an absolute sure thing in terms of the math. So that's the fundamental reason they're going to do it.
So you could bankrupt your insolvent institution and make a ton of money, and there's almost no way anyone can stop you from doing that.
No, because in addition, because the weapon of choice is accounting,
Mhm.
if you followed what we discovered in our autopsies, we in litigation, I was a litigation director that had just come to the agency. We autopsied every failure to look for common patterns. And we figured out that the accounting stuff they were doing, which is, by the way, quite reminiscent of what Trump
Mhm.
was doing, that he got convicted of in New York
Yeah.
for that whole series of frauds.
The
Those were
mortgage
all
frauds basically that he did.
right. So these are mortgage frauds,
Mhm.
and massive construction loans. So
Mhm.
these would be those big buildings in big cities where the lawyers and the accountants are. So they're 100 million a pop.
Mhm.
In that era, now they'd be 250 million dollars. The accounting for those kind of loans, I won't take you through the details, though you can read the book,
Mhm.
um, creates a sure thing of creating non-cash income. All right. So you're not actually receiving dollars, but under accrual accounting, someone supposedly owes you. And so you get to count it as an asset, even though that person can't actually pay you back and
And
has no intention of paying you back.
won't ever pay you back, right? So you're
Right. So
okay.
this
The
stuff is
weirdness.
actually a lot of fun to weird folks like
Yeah.
myself because it is so audacious. But again, I won't take you through the details because if you start discussing accounting, most people fall asleep within about 5 seconds.
But it does.
Okay,
So, but yeah, finish this thought, and then we'll go. I'll
so
ask.
this is going to go really badly
Mhm.
because the way you optimize it is to grow exceptionally rapidly and all do the same thing. And then pretty soon there are 300 of these savings and loans. And one of the reasons they kickstart, go from 0 to 180 miles an hour so quickly is they don't have to reinvent anything because it's the same guys originally that did the Texas Rent-A-Bank
Right.
scandal,
So it's like
and
cut
the
and
others
paste.
just emulate and hire people from them. So everybody's following tiny variants of the same, we came to call it the recipe, right?
Okay.
And the fraud recipe is just you grow really rapidly by making incredibly crappy loans, but with virtually no loss reserves. And, you just book extraordinary income.
Mhm.
And when the loans are about to default, the saying in the trade is a rolling loan gathers no loss. To roll a loan is to refinance it with an even bigger loan,
Right.
right? So it guarantees record income. As more people come in, they actually hyperinflate the bubble because they're all doing commercial real estate
Mhm.
in the best, which is to say worst cities to
Mhm.
do this. So that's going to hyperinflate the real estate market. They're going to report big profits. They're going to arrange phony sales that aren't really sales of these buildings at massively inflated prices. Then they're going to book more gains, and the loan is weirdly structured so that they actually profit a whole bunch from those phony sales that they've refinanced. And then there's going to be a radioactive cavity
Right.
where the thrift was, but there will also be a radioactive cavity all through the cities that this happens to, because the phrase was see-throughs, because no one actually was in these
Mhm.
massive office
That's a good
buildings.
term.
So you could see right through them. There were
Mhm.
no tenant improvement walls. And of course, it creates a bubble. Everybody feels great, and then it collapses. And then all the honest merchants and landlords can't compete with any of this. So you get at least a regional economic catastrophe
Wow.
as well.
So it has a
What's going to
huge
be
impact on the
different
economies of
in the
these
great
cities.
financial crisis is it'll be nationwide.
Right.
And it
Um,
won't be in commercial real estate, it'll be residential.
right. And this is the thing about this the SNL crisis is mostly commercial real estate, right?
Yes. The
Now,
second act.
the second act,
The third act becomes the great financial crisis,
which
and that
includes
is residential
right.
real estate entirely.
So junk bonds. Tell us what junk bonds are.
Okay, so junk bonds are simply bonds that are below investment grade. And that's basically sort of B minus-ish type
Yeah.
stuff. If people are used to AAA, that's the best. A junk bond has a very substantial risk of default. A AAA bond is supposed to have virtually non-existent risk of default in the near term of years.
So Michael
So
Milken
in
comes
the old
along.
days, nobody issued
Yeah.
junk bonds,
Yeah.
and when there was simply a market in them, a secondary market after the issuance as they fell in value, and
Right.
they were called, you like this, fallen angels.
Oh, it's a good term too.
Okay.
Um, it's a good spin. So Michael Milken comes along and he starts selling these impossible loans. Tell us what Michael Milken fits into this whole story, because that
Sure.
brings
So
us to
let me
Leon
tell
Black.
you how Drexel fits
Yeah,
in,
yeah,
which is sort of the point, and brings in Leon Black
yeah.
as well. So Drexel was a third tier investment bank.
Hmm.
Investment banks do initial offerings of stock and bonds and such, and traditionally nobody issued junk bonds. As I
Yeah,
said,
yeah.
they
Because why would you?
issued good bonds and
Yeah,
then they fell on bad times. And then there was like a secondary market in which you would package them.
fair enough.
Okay. So Drexel, being a third tier place, doesn't get the real good cash flow on the high credit quality stuff.
Right.
And Milken's thing is saying, so if we got garbage, let's call it great, right?
Yeah.
And that's what they did. And so what they did is say, we're different. We have unique abilities nobody in the world has except us to discern the diamond in the rough in all this garbage. So we find the best ones and then we structure the terms of the deal to protect you, the investor. And so it's not really as risky as the bond rating says it is, because the bond rating says it's trash,
Mm,
right? With a high rate of default. Now, this story, of course, is too good to be true. So naturally, everybody believes it because it's frigging finance,
right.
right? And if it's treated as too good enough to be true, then in this era, this is the era of hostile takeovers in the United States. And hostile takeover is just what it sounds like. I want to
Mm,
take over your corporation. Your corporation has a ton of money. It might even be profitable. I
right.
want to grab that money through this hostile takeover. But I'm a little dinky thing, right? Swallowing the whale, the little
Right.
fish swallowing the whale.
Mm,
And to get all this cash that I intend to use for me and for others, type of thing. So, how do I do that? I got to be super, super leveraged. But if you're super, super leveraged, you can't possibly get a AAA rating or anything close. You're going to get a junk rating.
mm,
So now this allows raiders that don't have very much capital to take over the crown jewels, as they were called, of American enterprise. And the idea, the milk and myth
mm,
story, which had a little bit of truth in what I'm about to say, was that the big guys that they were going to acquire were fat and happy and lazy.
right. Which
And
they were
they
a
would
little bit.
be new, tough, dynamic, you know,
Over leveraged companies to buy them.
alphas
Yeah.
type of thing. And
Yeah.
by God, they would get it into fighting shape
Mm,
and they would transform these entities, which were the problem of weak, placid CEOs into gems. And so win, 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 win for the general economy and such. And economists who should have known better loved it,
mm.
right? This is the greatest thing.
But couldn't they tell that they were over leveraged to the hilt? These would be impossible to
Right.
finance?
And you will recall perhaps that Modigliani Miller, this
Mm,
whole finance theory was it doesn't matter what your capital structure is.
right.
So fine, have 90% debt instead of the old days, 10% debt.
Yeah.
And it's even better because Interest is deductible. Dividends are not.
So loan as much as you can because it's all deductible.
Borrow as much as
Yeah,
you can.
yeah.
Borrow as much as you
Borrow as
can.
good
So
as
you're
you
going
can.
to have debt, and you're going to use the debt to shelter your earnings, except your earning, where the hell? In fact, you're not actually a particularly good business person,
Mhm.
right?
You just
So the savings tend to be, in many cases, not all, but in most cases, were non-existent. So how do we book income? Well, that comes back to the savings and loan type
right.
stuff, right?
Right. So just before we get to all of that, and specifically, the crash of 1987, I mean, this sounds like it was a haven for crooks. I mean, it sounds like if you were interested in a quick buck, this was the way to make it. If you were alive in the 80s, this is the ideal way to make money.
Yeah, so it wasn't coded crooks.
Yes, I'm sure.
Indeed, defenders of it argue that it was unfairly coded Jews,
Okay.
right? So many of the takeover folks were Jews, and they were taking it over from white bread Goyish guys like me.
Mhm.
Well, not like me. I never had money,
Yeah.
and such. And so that was the crackdown
Mhm.
that eventually came uh, when it turned out there was immense fraud, not necessarily on the acquirer's part always, but certainly at Milken and Drexel Burnham Lambert, that was a control fraud, right? A fraud where the person who actually controlled it, which was not the nominal CEO, but was Michael Milken and Leon Black. Those are the
Right.
folks who actually controlled the operation,
Right.
were using it to get rich.
And
Okay.
Drexel's really interesting for the Epstein story for those who are following along. Because Drexel is either the template for Epstein or even maybe he's something he participated in orchestrating. I've had people tell me that Epstein was part of Milken's universe, whether he was advising him directly at Drexel or whether it was his personal advisor. I'm not sure, but he was apparently an advisor. And Leon Black, of course, lands up being in Epstein's universe as well. Um,
So
and
let me tie
yeah,
this in a bit
yeah,
for you, if I may.
yeah,
So Leon Black's own story, self-deprecating story, is that he goes to one of the big investment banks and he's told he's not good enough, and that's how he ends up at Drexel,
right,
right? So this myth is the myth that the folks there were just the best hardworking folks, that they came in at 5 a.m.
right,
wearing miners glass lights so that they could read the prospectus and be ahead of everyone. That's a completely phony story,
right.
right? What was really going on was mostly the savings and loan industry, and this was the super link that we discovered that helped break uh, the whole Drexel stuff, right?
Right.
Came from breakthroughs in the savings and loan stuff. So, what I need is because I've not really, from Milken's
Yeah.
perspective, I got to keep a low default rate, right? An
Right.
unusually low default rate. So, the way to do that is to restructure the loan when it gets in trouble and they're about to default.
Right.
You reduce their payments, you stretch them out for years, et cetera, et cetera, et cetera. But how are you going to do that? Because that's often insane from the standpoint of the bondholder. Answer is, I'll have a crew of, there were roughly 11 to 14 savings and loan captives and one big insurance company. And so we discover our
You
examiners.
say
Let me be
captives.
clear.
What do you mean by captives?
I'm about to
Okay.
explain that.
Okay.
Okay. Um, our examiners discovered when you make a loan, right, and
Mhm.
a junk bond is a loan,
Mhm.
right? When you buy it, you're buying a debt type of thing.
Right.
So the savings and loan has to underwrite, show that it's understands the risk and such. All right.
Mhm.
But because Lincoln Savings Acquisition, this is Charles Keating, the most notorious of the savings and loan frauds. as an exemplar. But again, he's like 11 to 14 of these savings and loan guys. He doesn't have the money to acquire the savings and loan, and he doesn't want to use his own money. So he goes to Drexel.
Mm-hmm.
Drexel issues junk bonds of Keating's holding company. Okay. That gives Keating cash. Milken being Milken, he makes sure that Keating needs 50 million, so I loan him 150 million. So I've always got him by the short hairs.
Mm-hmm.
Right? Okay. In return, not in the deal, not in the written deal, but in the real deal, Lincoln Savings agrees that $1 billion of its portfolio will not be controlled by it. It'll be controlled by Milken.
Oh, wow. Okay. That is interesting. I didn't know that.
Off book. And Milken proceeds to buy and sell. Now, the first thing, of course, he does is what's called churning. You get a commission on, and you're working on both sides. You're representing both sides of the deal. So you get a double commission. So you do a lot of sales and churn. But more, whenever there was a question of would the debtors, the people holding the junk bond, approve the restructuring, which actually, after all, screws them, right? The restructuring is designed to screw them, right?
Yeah.
Lincoln, of course, would sign on because Lincoln wasn't doing anything.
Doesn't matter to them, right?
Had Lincoln's $1 billion and could vote the $1 billion, and Lincoln Savings had no role.
Wow. Okay. Completely kited out.
Let's just one more to pull this together. But they forget, because it's Drexel doing all the decisions, and Lincoln doesn't even know. It literally doesn't know till the end of a day in the telex what it now owns in junk bonds. Right? They don't even tell them really contemporaneously. So obviously they couldn't do any underwriting, right? Because they never knew the deal was even being done.
Right. Wow.
And then someone wakes up 2 months before our exam and goes, oh, the examiner's going to come in and they're going to look for our biggest loans, which are these loans. When you buy a junk bond, you're making a loan.
Right.
Clear to people? Okay. And so they hire Arthur Anderson, about to be of infamy, and say, stuff the files and make them look like they're contemporaneous documents that were used in an actual underwriting. And so they're already the auditors, and now they become the consultants to pull this scam. And they produce tens of thousands of documents, carefully undated, put them in the files. And when we ask for the underwriting files, they go, here they are.
Wow. And then just getting fake information. Basically.
I just got to get this one guy.
Yeah.
Our guy, a lawyer and an examiner, Bart DeZevi, is looking through this most boring thing in the history of the world, 10,000 of the pages of this stuff. And he notices some pages are not paginated in order. And he begins pulling the thread, and that's what leads eventually to the discovery of this whole scam, and is a major part of bringing down Drexel, Burnham, Lambert.
And this is happening across other parts of the financial sector, or was this particularly just Drexel at this time?
No, it was definitely Drexel. Drexel was sold as unique and was at this time unique. But your question is the right one, because what happens after we take the enforcement and criminal actions against Drexel is the diaspora of Drexel.
Okay, before we get there.
They go out like bad Johnny Appleseeds.
Yes.
Spreading fraud all through the
every way we can. I'm going to try to play something from CBS News from 1987. I may not play, but I'll try. This is what it looked like on Black Monday.
People are getting killed.
In an almost unbelievable wave of panicky selling, the Dow Jones Industrial Average today plunged, a record more than 500 points down in by far the busiest session in Wall Street history. That was going on at home on a day when U.S. warships retaliated against Iran in the Persian Gulf.
The Iranian platform at Rashadat also is called Rustan, was destroyed this morning by a United States naval gunfire.
No, we're not going to have a war with Iran. They're not that stupid.
Good evening. This is the CBS Evening News. Dan Rather reporting. The extraordinary, if restrained, action taken in the Persian Gulf early this morning was overshadowed through the day by scenes such as Wall Street has never witnessed, as the Dow Jones Industrials took off on a fear-fed freefall to close down a record 508.32 points. Panicked traders worked through lunch hours in a desperate but losing attempt to keep up with tickers that rolled up an all-time high volume. CBS News business correspondent Ray Brady looks at this devastating day for the market.
They're calling it the Monday Massacre, the worst drop in Wall Street history.
I just came from inside and it looks like a madhouse.
So crazy. Nobody even expected it to be down this much.
Hour after hour today, wave after wave of selling hit the stock market. A selling panic, the professionals call it. By the closing bell, the Dow Jones Industrial Average was in the steepest fall in its 103-year history, down more than 500 points. The volume of trading was way beyond anything ever seen before.
Well, if you had any kind of objectivity, even if you lost tens of thousands of dollars, you could find something, it was fascinating. The way sometimes a bloodbath is fascinating.
In San Francisco and Los Angeles, the stock exchanges closed early, unable to handle the flood of sell orders. And in New York, the high-speed ticker tape fell 2 hours behind. On Black Monday, October 28, 1929, the market dropped 12.8%. Today's loss was far greater, more than 22%. Estimates are investors lost more than $500 billion today. Computers kicked off some selling programs. Also, those stock prices had reached dizzying heights.
We've had a great deal of over-speculation. You've had 29-year-olds making $1 million a year, expecting to make $1.5 million next year and $2 million the year after that.
President Reagan said late today the economy is sound.
All the business indices are up. There is nothing wrong with the economy.
But many Wall Streeters say the big sell-off in stocks was the result of the administration's economic policies, the weak dollar, rising interest rates, and those two deficits in trade and government spending, plus nervousness over the Persian Gulf. On one market, prices rose. Gold was up $10 an ounce. Bad news for other financial markets.
The price of gold is like the price on a thermometer. You can equate the temperature of the world by looking at gold prices. And of course, as the economic temperature of the world heightens, so does the price of gold.
Wall Streeters interviewed tonight were mostly gloomy, many of them saying they feel the big sell-off hasn't run its course yet. Dan?
Ray, the question everybody wants to know the answer to, is this 1929 all over again?
Well, Dan, there's no question that the market today dropped on a percentage basis greater than it did on that terrible day in 1929. So you've got that. On the other hand, we've got a much stronger economy today, and we can only hope that a lot of the regulations that were put in Wall Street after 1929 will now come to our rescue.
Ray, thanks.
This goes on a little bit, so I'll stop it there. But take us into Black Monday then, because it was related. Let me just try turning him here down because I can still hear him. What's your assessment of that reporting first? Because it's kind of a gem in some ways. The characters are so fantastic in there, but in other ways, does it accurately reflect what happened that day?
Okay, so I like the fun part of a high-speed ticker that's 2 hours behind.
It's true. By today's speed of
tech.
Yeah.
Real high-tech type stuff. Okay, so the report, of course, is accurate about the drop and the percentage of the drop. And what happened is the Fed flooded the market with liquidity. In the modern era, this is called using the bazooka type of thing, and the markets pretty quickly stabilized. It had no macroeconomic effect probably at all.
Oh, really?
Apparently, one person committed suicide, on Wall Street as part of this. But there is a story. A great story of how bad both the industry and the regulators had become under this aspect of Ronald Reagan. And remember, this is as we're getting all these convictions and such. So it's a really psychotic world
Right.
in which the opposite things are happening in many places.
Did the SNL, the Milken thing that you were talking about, and Drexel, did Drexel feed into this collapse, or the junk bond crisis feed into this collapse?
In a way. Give me this takes a couple minutes.
No worries. Good time. Good.
Okay.
Nothing but time here.
Do this. Remember, I talked about interest rates, right? So the largest savings loan in America, which was big, like, that $45 billion in that era, it would have been the 8th largest bank in America-ish type thing. So not a teeny place, was experiencing a huge run. And there was this heroic effort to save it by the Federal Home Loan Bank of San Francisco by making secured loans, where we had people doing triple shift stuff for all 24 hours, finding assets that were worthy to be collateral and making loans and all of that. Okay. So the head of the agency, Ed Gray, uses that to get rid of the CEO of this place, who would otherwise be invulnerable, that he was so powerful. Okay, so they're going to take him out, and they put a new person in, all right? And that new person is a traditional type with an industry reputation and all that type of stuff. And he immediately stops what they thought was the problem, which was taking interest rate risk and losing. And you lose on interest rate risk when interest rates go up. Okay. So, okay, great. And the new loans he starts doing turn out to be really well underwritten and very safe and not exposed to interest rate risk. They're adjustable rate mortgages. All great, except that every month the institution's losing money. It's got no defaults on all the new loans, and it's losing money. And they're going, what the is going on? And then the examiners get in and they go, well, because this is a fraud operation of the kind that I described. That is making bad construction loans on major buildings. And so what the reason there weren't defaults was what I explained. They just made bigger loans, or they funded acquisitions of their building, but they were really still on the hook for the building. And so the losses were, the credit losses, as opposed to the interest rate risk losses, were growing and growing and growing, but not being recognized. And nobody was telling the CEO, hey, this is all a scam we're running.
At least so they say. I mean,
on the big loans that you inherited. Your new loans are fine, but the construction loans are blowing us all to hell. Okay. They change, and Ed Gray is gone, and Danny Wall comes in, and he's a super free market Republican staffer that knows nothing about finance but thinks he does because he was a staffer, of a powerful, very right-wing Republican senator from Utah, Jake Garn, type of thing. And Danny knows we can't do what the examiners say because everybody knows we saved this institution, which was called FCA. And so we can't undo that by admitting the place is insolvent. So what we should do is have an interest rate gamble. Let's do lots of fixed rate mortgages. So again, fixed rate mortgages, I like they sound. If inflation goes up, The interest rate doesn't go up, so the bank isn't protected against that. But Danny knew that the days of increasing interest rates were gone because Danny was a moron, right?
Okay.
And so remember, we, the regulators, have
Yeah.
been fighting for 15 years to get savings and loans to take interest rate risk seriously.
Yeah.
And Danny Wall says, on a dime,
Forget about it.
screw that.
Yeah.
Let's
Go crazy. Let's have a party.
massive interest rate
Yeah.
risk. Let's not just take interest rate risk. Let's grow FCA rapidly, taking the interest rate
Why?
risk.
Why would he do this?
So that he wouldn't. So Danny Wall, this is just before the elections.
Ah, okay.
And the leading liability the Republican Party has is this savings and loan crisis that has blown up on its watch. So there's got to be no crisis. So Danny Wall is constantly lying about all the numbers.
This is the
and
Bush
saying,
is
"We
running
don't
for
need
president
any
here."
more money in this insurance fund and such. And there isn't any real problem with fraud, et cetera, et cetera. So this is they're just like the current Trumpy,
Right.
Heist.
Is this Bush is running for president at this point, and it's his election campaign?
It's clear that Bush will be Bush, the vice president, who is in charge of the financial deregulation task force under President Reagan, and is even more aggressive a deregulator, right? So real men take risk, right? Wussy types warn about risk and say you should hedge against interest rate risk. Screw that. We're the new breed of folks. Jake Garn was bald and called himself a thermo sex machine or something like that because of the bald pate.
They say that about Stephen Miller these days too. So
these folks are psycho.
Yeah.
Okay. And we go, no. And we're the regional regulator of the institution going, no, that's insane. Do not do this. And they order it to be done. They literally order not only continue to take interest rate risk, greatly increase the interest rate risk, it'll
accelerate the crisis, make things even worse.
Profitability.
Yeah.
And of course, month after month after month, interest rates climb, which, by the way, is why we're going to have this Black Monday event. The Friday before Black Monday and the Saturday before Black Monday, it has become clear that FCA, the largest savings and loan in America, when we have nothing in the till and Danny Wall is lying and the election is coming, see this bad scenario?
Yeah, it looks terrible for them.
It's going to fail within 3 days.
Wow. Okay.
And that will be all over the press and all over the election cycle, and there may well be a nationwide run, and we still have virtually no money to actually be able to pay depositors.
No.
So they're meeting with the Federal Reserve on Saturday because the Federal Reserve has the funds, in an emergency, and we literally, to break a run, put piles of cash from the Fed with the Fed name on it on top of where the teller is.
Yeah.
That's how psychologically you break these runs. So that's what they're arranging, how we're going to get, because this place, again, it's the largest savings and loan in the world. So it's got branches all over California. How are we going to get cash with armored cars to every branch of all of these things?
Wow.
And on Monday, instead, you get Black Monday, and the Fed tosses in massive amounts of liquidity at incredibly low rates. And what happens to interest rates?
They go down.
They go down.
Yeah.
And so the bet that Danny Wall made that the rates would go down, instead of losing over $2 billion, only lost $1 billion. And they were able to save this institution. So all over America on that day, people are in horror except at 17th and G, which is where the Federal Home Loan Bank Board was located, where they're having the party of all time that they had been saved by Black Monday.
Now, does that mean that Black Monday might have been a construction that, someone thought, well, there's another way out of this, and certainly there's indications that some people knew ahead of time. Some people were shorting that market. Some people were aware of these things.
Sure. But I mean, again, rates had been rising for a very long time, right? Then you get this potential war news. Markets are psychological in all of these things. But what that report didn't talk about, because they didn't know yet, in fairness to them, and this is a pretty sophisticated thing, is this was the era of